Welcome to Corporate Finance. In Chapter 11, Problem Number 1, we have nightshade sunglasses. Variable material cost per unit is $12.14 per unit, and variable labor is $6.89 per unit. Fixed cost of $845,000 to produce 210,000 units. Selling price is $49.99 per pair. Depreciation is $450,000 per year. What is the variable cost per unit? Total cost for the year. Cash break-even point and accounting break-even point. So your equations are variable cost is material cost plus labor cost per unit. Total cost are fixed plus variable. And cash break-even point is fixed cost plus 0 OCF over contribution margin. Accounting break-even point is fixed cost plus depreciation over contribution margin, P minus V. So to solve for the variable cost per unit, I want to add the material cost plus the variable labor cost, and I get $12.14 plus $6.89 or $19.03 per unit. Remember here that units are important in every problem. Solution for total cost is $19.03. Variable cost per unit times 210,000 units plus $845,000 of fixed cost, and I get a total cost of $484,100. For cash break-even quantity, it's fixed cost plus OCF, which is 0 at the cash break-even point, over contribution margin, or $49.99 minus the $19.03 that we calculated for variable cost, and I get 27,293 units. And for accounting break-even, we have fixed cost plus D over P minus V, fixed cost plus depreciation over contribution margin, and I get an answer of 41,828 0.17 units. And there are your answers to problem number 1. For problem number 2, we have Ojo Outerwear manufacturing mountain climbing shoes for $45.17 per pair. Variable material cost plus $29.73 variable labor. Shoes sell for $210 a pair. Nice margin there, as they say on the Shark Tank. Production is 155,000 pairs. Fixed costs are $2.15 million. What are your total production costs, marginal cost per pair, average cost, minimal accepted revenues for a one-time order? If I get a one-time order after all this is said and done for 5,000 more pairs, what should I charge? What will my sales be to cover the cost of those 5,000 pairs? Equation: total cost is fixed plus variable. Marginal cost is the cost of one more pair. Average cost is total cost over a production quantity, and minimal acceptable revenue for 5,000 pairs is the contribution marginal cost per pair times 5,000 pairs. So that should be marginal cost per pair times 5,000 pairs. Total costs then are labor plus material times 155,000 units plus fixed cost of 215,000. I get a total cost profile of $13,759,500. Total cost, marginal cost for one more pair is the cost of variable material plus variable labor, or $74.90 per pair. Got that by adding $45.17 plus $29.73. Average cost is total cost of $13,759,500 divided by 155,000 pairs, and I get $88.77 per pair. Average cost. And finally, minimum revenue is $74.90 marginal cost per pair. I want to just cover that times 5,000 pairs, so minimum acceptable revenue is $374,500. And there are your answers to problem number 2. Stinnett Transmission says their estimates are accurate to plus or minus 15%, and they have a price per unit in the base case of $1,200 per unit, a variable cost of $380 per unit, a fixed cost of $3.75 million, and quantity of 90,000. And do the scenario analysis. So that is the base case. Now do the best case and the worst case. at plus or minus 15%. So in the best case, the price goes up 15%, so I multiply 1220 times 1.15. The variable costs go down, so I take 380 times 0.85 because they go down 15%. Fixed costs also go down 15%, so 3750000 times 0.85. And the quantity goes up, so I take 90,000 times 1.15. In the worst case, the exact opposite happens. The price goes down, so I take the 1220 times 0.85. The costs go up, so I take 380 times 1.15 and 3750000 times 1.15 because costs go up 15% in the worst case. And the quantity goes down, so I take 90,000 units times 0.85. And those are answers for problem number 3. In problem 11.4, we have the company in the previous problem where their management is most concerned about price. How do you address this concern? Very simply, I want to do a sensitivity analysis on price only, hold all other variables constant. So variable cost, fixed cost, everything else, just hold it constant. Change the price a penny at a time. And obviously do a P&L income statement, calculate the OCF, operating cash flow from that income statement, and then do all the Chapter 9 analyses like NPV, IRR, and so on. As you change those, you get a bundle of NPVs and IRRs as you change those prices, 1 penny, 2 pennies up and down in both directions, and that will show ease any concern you have about price sensitivity. Moving on to problem number 5, we have a project that cost $845,000, 8-year project, zero salvage value, depreciated straight line to zero, sales of 51,000 units per year, price is $53 per unit, variable cost $27 per unit, fixed cost $950,000, tax rate is 22%, and the required rate of return on this project is 10%. Calculate the accounting break-even, the degree of operating leverage at the accounting break-even quantity, OCF MPV for 1 unit decrease in sales and then 1 unit decrease in variable cost. What happens to the OCF? So the equation for accounting break-even is fixed cost plus depreciation over contribution margin. And obviously we can calculate OCF the traditional way, EBIT plus D minus T. If there's no interest expense, we can go bottom up with MPAT plus D. The degree of operating leverage is 1 plus the quantity, fixed cost plus OCF. And the net present value is minus the initial investment plus all the discounted cash flows coming in over the 8 years. So to calculate depreciation, which we're going to need later, let's go down to the depreciation numbers and calculate it. And that's very simply for a straight line, it's just the cost of the project, which is $845,000 divided by 8. And we get a depreciation amount, straight line of 105,625. Then they want to know what is the accounting break-even quantity. It's fixed cost plus D, which is OCF. D is $845,000 over 8. And divided by contribution margin of 53 minus 27, and I get an accounting break-even quantity of 40,600.96 units. Obviously, in production, we would up that to 1 unit. For degree of operating leverage, we would calculate that. That's 1 plus fixed cost over OCF, which in the accounting break-even quantity is depreciation. So 1 plus quantity, 950,000 over 105,625, I get 9.9941 times. That is for every 10% increase in quantity, we get a tenfold increase, 9.941 time increase in OCF. So it levers it up. That means they have high fixed cost. To solve for the base case OCF and MPV, I need to do a P&L. Whenever I see the letters OCF, I need EBIT plus D minus T. So my sales are simply $53 per unit times 51,000 units. Variable costs are $27 a unit times 51,000 units. Fixed costs are fixed at $950,000, and my depreciation we calculated earlier at $105,625. That leaves me with EBIT of $270,375. My taxes at 22% of that are $59,482.50, and my net income is $210,892.50. From that P&L, I can do the OCF. It's EBIT, $270,375 plus depreciation added back because it's a non-cash expense. 105,625 minus taxes of 59,482.50. I get an OCF for this project of 316,517.50. That OCF will come in every year for 8 years. So it's an 8-year project with a 10% required return. I can calculate the present value annuity factor because that OCF is indeed an annuity, 316, 517.50 per year for 8 years. So my present value annuity factor is 1 minus 1 over 1 plus 0.1 to the 8th over 0.1, and I get a 5.3349 PVA factor. Like I said above, my OCF is 316, 517.50. That's how much we will get every year for 8 years. And then my net present value is the minus 845,000 project cost plus those cash inflows in E66, 316, 517.50 divided by 1.1. Then the same cash flow again divided by 1.1 squared, same cash flow again divided by 1.1 cubed, and so on all the way out to the 8th year. And I get an MPV of 843,597.50. For a 1 unit decrease in sales, it's just after-tax contribution margin, so that's $48 per unit minus $27 per unit, P minus V times 0.78. That's what's left over after tax, and I get a contribution margin of $20.28, and that should be $53 minus $27. And then I take that contribution margin times the PV annuity factor, and I get an MPV, after-tax MPV per unit decrease in sales of 108.19, and I multiply that by 500, which will tell me my MPV decrease for 500 units, negative 54,096.15, and the OCF increase for a $1 unit decrease in variable cost. I take $1 times 51,000 units times 0.78, and I get an OCF increase of 39,780. And there are your answers to problem number 5. Moving on to number 6, we're looking at some scenario analysis, base case, best case, and worst case in the prior problem. We think that price, cost, and quantity are accurate to plus or minus 10%. So we'll do the base case that we just did above, and then we will do a best case where the prices go up and the costs go down, prices and quantity go up and costs go down, and then we'll do a worst case where the prices go down and the quantity goes down and the costs go up. So to get the best case, I multiply my base case price times 1.1, I multiply my base case variable cost times 0.9, my fixed cost times 0.9, and my quantity times 1.1. And in the worst case, I do the exact opposite. I take the base case price, selling price, times 0.9. I have the cost go up, so I multiply the base case values by 1.1. And then for quantity, we have the quantity going down, so we take 51,000 times 0.9. Multiply these out, and we get the P&L. Base case net income is 210,892.50, as we had previously in the prior problem. There it is, 210,892.50. And then we see that the NPAT or net income goes way up in the best case, and it goes way down to negative 253,000 in the worst case. My OCF is still 316, 517.50 as per the prior problem, and my MPV is 843,597.50 at 10%. It's accept. The best case, because of that high net income, I have a really high OCF, and my best case MPV is 3,658,261.89. Big accept there. However, in the worst case, I have a negative net income, I have a negative OCF, and I have a big negative MPV, so decision would be reject in the worst case. And there are your answers to 4, 5, 6. In problem 11.7, we're looking for, in these 3 cases, the accounting break-even and the cash break-even. And you can see all the givens for cases 1, 2, and 3, varying prices, varying unit costs, varying fixed costs, varying depreciation. The equations are accounting break-even quantity is fixed cost plus D over P minus V. So in this first one, I'll be taking 7.2 million plus 2.9 million divided by quantity 2980 minus 1640, and I get 7537.3134 units. For cash break even, it's fixed cost plus zero of our contribution margin, so it's 7.2 million. Divided by quantity 2980 minus 1640, and I get a smaller number of 5373.1343 for cash break-even quantity. I do the same things for case 2 and case 3. Counting break-even quantity, case 2 is 91,600 units, and the cash break-even quantity is 55,000 units. For counting break-even quantity for case 3 is 1380 units, and for cash break-even quantity, case 3 is 1160 units. And there are your answers to problem number 7. And finally, for problem 11.8, we have some new quantities, some new units, some new unit prices, new unit variable costs, new fixed costs, new depreciation numbers. In case 1, they want you to find the depreciation. So basically you solve the accounting break-even quantity for depreciation and you get $469,574. In the case 2, we're looking for unit price with different givens. So again, we solve that accounting break-even quantity for price and I get $58.59. And in case 3, we're looking for unit variable costs, so we're looking for little v in the accounting break-even quantity equation. Solving for little v, we get $77.16, and there are your answers to problems 7 and 8.